in it. So yeah, let's wait just a minute or so, and we'll be starting. Today we have a lineup of great speakers. We're gonna have two speakers. We're gonna have a guest speaker. There are plenty of announcements that we're gonna do today as well. So I think it's gonna be extremely good meeting today. So really looking forward to it. And yeah, there are some announcements that we're gonna make. I would like also to take that half a minute or so to tell you all that it's been a great journey so far, and the amount of people is overwhelming who joined 0xPoland. We more than double the amount of people from the first to the second meetup. We more than double the amount of people who joined us. So it's really great. And yeah, I think without further ado, we're gonna start. So let me tell you, I'm Marek from EthWorks. We are organizing it together with Maker. And let me remind you why we're doing it. We want to build a lasting developer blockchain community here in Poland, but open to really anyone in the world. And we have a great media partners. CryptoDev.tv is Rozumieć Bitcoina, who help us promote and who help in our mission to build a lasting community of developers, of blockchain developers. And it's gonna be our third meeting today, third meetup that we organized. We also had a workshop last month, a weekend workshop, and I'm gonna tell you a little bit more about it in a moment. And we're gonna have 5 more meetings this season, including today. We're gonna have a student workshops, and we're gonna have more weekend workshops, and we're gonna have a hackathon. So I wanna tell you that last workshop, there was a great amount of demand, and we had to, and thanks to Maker, we were able to do 2 groups instead of 1. So there were 2 groups, each was 10 people, all everyone showed up, so that's really great. And that was we were only able to invite half of the people who sign up. So therefore, we would like to announce that in top of student workshops that we start in just a few weeks, and another workshops in May, we're gonna do additional workshops in April that's gonna be led by the Maker team, so that anyone who would like to can join and start learning blockchain development. We also announced earlier that we're gonna do a hackathon in May. The dates for the hackathon has changed. It's gonna be similar time, but a little bit different because it's gonna be remote first. So it's gonna be fully remote hackathon that's gonna start on Friday, 21st of May, and we're gonna finish on May the 29th. And I'm happy to tell you that we're gonna have some great partners, some great sponsors. We already secured $25,000 for prizes, and I think it's gonna be much more than that because we just started working with our partners and sponsors to build this prize pool. So we're gonna announce, we're gonna have a great speakers, we're gonna have great workshops, and we're gonna have a great prize pool. So I would like to invite you all. Follow us on our social media, follow us on Twitter on 0xPoland, but also we just opened Discord, so please join us on Discord, and you can expect announcement of specific partners and prizes and speakers in upcoming weeks. And today, we're gonna have 2 presentations. There's gonna be introduction to DeFi by Bartek Rutkowski from EthWorks, who's gonna explain what the whole decentralized finance buzz is all about. And then we have a great guest speaker from Balancer, Alex van der Sande, who's gonna explain in particular what is the state of automated market making and why we should already go beyond that. So really great lineup. And without further ado, I will let Bartek start his presentation. Yeah. So yeah, I think we're ready. Bartek, are you joining us? Wonderful. Hi, Bartek.
Yeah. Hey, yes, great to be here. Yeah, so I think I'll take it from here. So introduction to DeFi. Today we're gonna talk about what this whole DeFi thing is all about. We've heard on the previous meetup something about ERC20 token standard. We've heard on the previous event something about coding debt. Now it's time to put all these pieces together and compose a bigger picture that will be actually useful and that will be actually bringing real value to this world, so we can utilize it and see why is it so important. So before I continue, I just want to mention that I'm not a financial advisor. Nothing what I say should be treated as such. And I know my excitement might sound like a financial advice, but it's not one. So it's only my private opinion about that. Okay. So what is DeFi? DeFi stands for Decentralized Finance, and this is whole ecosystem of different sorts of projects that utilize smart contracts on Ethereum blockchain. Not necessarily on Ethereum. DeFi refers to all of the projects that deliver financial products across different blockchains, but it's mostly Ethereum these days, as Ethereum holds the majority of utilized liquidity, and the most devs create stuff on Ethereum blockchain. And as we can see, there is this aggregator of data which is called DeFi Pulse, and that's a screenshot that I've made for a similar presentation that I was doing around 2 years ago. So 2 years ago, there were like some projects with some amount of USD locked inside. The total value locked in the DeFi was $500 million, and Maker was like a solid leader, and that was actually the only project that was kind of on the scene. And today, and that's actually the screenshot taken today, we have $37 billion locked in different DeFi projects, and Maker, which still holds the strongest position on the market, is not a killer. It's not a tyrant that holds everything. So it's growing rapidly. Like the tempo of growth is outrageous, and the ecosystem is really flourishing. Yeah. So what is this DeFi thing actually doing? We say decentralized finance, so we imagine some financial stuff. So let's start with the simplest example possible. Let's imagine simple banking. What is banking all about? We have our hard-earned money and we put it in a bank. We put it in a bank because we want it secured, and some time ago, we even used to pay for that, right? Because banks provide security, banks can make sure that we won't lose our money, and we were paying for that. Some time passed, and banks realized that it's nice to actually use this money inside because it can be lent, it can be utilized in some way that it brings profit. So we won't need to pay to the banks anymore, because the bank can make use of our money, so it can profit. And actually, it also brings profit to us, right? Because we deposit money into the bank and we receive some small portion of gains created with the capital that we have put in our bank. Sounds like a simple example, sounds like a simple truth that we put something in the bank and we get a little bit of profit. So I think it should be possible to do it with smart contracts on a blockchain using primitives that we discussed in previous months. So let's explore Compound. So first of all, we have some portion of DAI. DAI is a ERC20 token, like one of these we discussed a month ago, and one unit of DAI is always worth $1, around $1. And let's imagine that Compound is this sort of a smart contract bank, and we put these DAIs into the Compound. we put them into there, we deposit our cash into the bank, and we get some virtual number, which is, in this case, another ERC20 token, which just says, this guy deposited this amount of money into the compound. It's like, it represents our share in the whole pool of funds in the compound. And how this money, this token in the pool can bring any profit. On the other end, we have a guy that wants to borrow it. So he puts collateral, and because the value of the collateral is greater than the amount of the funds that we want to borrow, he is able to borrow the funds from the pool. We need to do that because we need to make sure that he pays it back, because his collateral is more valuable than the DAIs he took. So he's incentivized to actually pay it back. After some amount of time, before that, I think it would be nice to make a comparison to the traditional finance, because imagine a mortgage, right? The collateral might be considered, for example, a piece of real estate. In normal case, you put the ownership of a piece of real estate, like you pass it to the bank, so the bank can hold the real estate actually, so you can borrow funds needed to complete the purchase. And then after some time, you pay back money and you truly become an owner of the real estate. And similarly here, you put Ether, for example, some sort of collateral into the compound, you borrow DAI, and after some amount of time, you pay the DAI back, or your collateral is taken from you if you are not willing to pay your debt back, and that generates profit. And that generates profit because that's, of course, not for free. And then the girl on the left side, who was first to deposit her funds, her hard-earned DAIs into the compound, can withdraw with a profit. Most of the profit goes to her, and some small portion of these funds is left in the compound pool, as compound is indeed not a charity. And this model works extremely well. It's extremely simple and works well. And now there's something I missed, because actually the guy that put the collateral into the compound also receives some token that represents his funds located in the pool, right? Because he also had to locate something into the pool, and then he should be able to withdraw it. So now we have an interesting case, because now we see that not only the DAI depositor can borrow Ether, not only Ether depositor can borrow DAI, but also DAI depositor can borrow Ether. So both of the sides can deposit something, earn some yield on top of that, and borrow other funds that are located in the pool. And now, how does it happen that these funds are not blocked forever, right? Because we have now the girl on the left who might intend to withdraw her DAI, and they are not there, right? So how does she do that? And on the other hand, there's a guy on the right side which might want to withdraw some amount of Ether, but it might not be possible because this amount of Ether is not present in the pool. So now we have this thing called utilization ratio. And utilization ratio says how valuable an asset in the pool is. So as we see, most of the DAI is located in the pool are already utilized. So somebody borrowed them; they are not there, and that indicates the high cost of such loan, right? So high cost of such loan, on one hand, incentivizes more DAI depositors to deposit into the pool, so they can earn high yield, and on the other, it incentivizes borrowers to pay their loan back because it's just expensive. And we see similarly with ETH, only a small portion of ETH is borrowed, so it's not needed that much anymore, and we do not incentivize more people to put their ETH into the pool. But on the other hand, borrowing this ETH is not that expensive, so anyone can do that. Yeah. And as we now consider these two sides of the pool of the compound system, which is pool and collateral, we can actually see that it should be only one thing, only pool. People deposit stuff, whatever it is. They gain borrowing power because they can borrow against their deposit, against their collateral, and they can earn yield on top of stuff that they deposited. Simple and extremely powerful. Actually, I can tell you even more, and that might be only that will be only a teaser because I don't want to dive too deep into this one. But it's possible actually to borrow something from the pool without any collateral, but only in such a case if you do this for a very, very, very short period of time, and this period of time is only one transaction. So you need to borrow and pay back a loan in the same transaction. You need a special smart contract for that. And this is extremely useful tool that we cannot see in the traditional banking system, at least not available for retail users. And I think that we will explore it sometime later. But yeah, it's also possible. Synths. So we were talking about this compound example about different sorts of tokens, right? The ERC20 tokens, and there was this DAI. I was saying that one DAI is worth $1, but actually, why? Why is DAI worth $1? And actually, why anyone accepts DAI when anyone can deploy an ERC20 token, and it's like just a piece of code. So what is actually DAI? At the beginning, let's explore this synthetic asset like in depth. What's essentially a synthetic asset? So we are going to start with the simplest possible example, which is wrapped ether. Wrapped ether is an asset that solves one very painful problem of smart contracts. We have an ERC20 standard. All of the projects utilize ERC20 tokens. We have dozens, hundreds of different ERC20 tokens, while we have ETH, which has completely different interface. So whenever you create a system like, for example, Compound, which utilizes both tokens and ETH, you can implement it for an ERC20 token, which utilizes 99% of the whole market, and then this one edge case for ETH, which is not an ERC20 token. So how to fix that? So apparently the easiest solution is to just wrap an ETH in a token, right? So you can put your ETH into the vault, and this vault, whenever you deposit into this vault, will give you exactly the same amount of wrapped ETH. This is like extremely simple, right? This is basically the code that's responsible for the logic of depositing and withdrawing. Whenever you deposit stuff, you pay some amount of Ether, you receive proper amount of wrapped Ether, and the other way around, whether you want to withdraw, you just create a transaction that will pull your tokens from your account back to the vault, burn these tokens, and return your ETH. As simple as that. And we have a lot of synths like that. This one is the purest, but this is kind of a synth that we can call a custodial synth. This is a synth. There is like one issuer of the token, one issuer of the currency, and this issuer guarantees that anytime you pass them your asset, whether it's Bitcoin or whether it's US dollar, they are gonna mint you proper amount of token representing the deposit. So you can take one Bitcoin, pass it to the wrapped Bitcoin issuer, and you will get wrapped Bitcoin on the Ethereum blockchain. You can deposit US dollar in a special account, and then you will receive USDC or TUSD on Ethereum blockchain. but still it's not DAI. What is it then? So far, we are discussing only tokens which are hard pegged. Hard pegged means that they are hard pegged to their origins. So they can always be one wrapped Bitcoin can always be to one USD, and especially one ETH to one wrap ETH and the other way around, because that's such a very simple smart contract transaction. DAI doesn't work like that. So how does it work? DAI is a token which was introduced by the Maker Foundation, which was like the first great DeFi project. And the idea is like this. You put your ETH into a special vault. This special vault evaluates how much ETH you put in there, like in dollar value terms, right? So not like it's one Ether. It's like there is an Ether worth of $200, whatever. And then you can create an amount of DAI that is always lower than the amount of ETH inside the vault. So DAI is like kind of, let's say for now, it's like Ether-backed stablecoin, right? So it's a token, it's a currency that's backed by the value kept inside the vaults in different sort of currencies, like for example Ether. Like we had the gold standard, right? So some time ago, like each US dollar or whatever else was backed by some amount of gold put into the special vault, which was a bank. And now we have this. It's not the same. I know it works slightly different, but there are similarities. And after you create these DAIs, you can do anything with them, like literally anything. You can sell them, you can exchange them, you can keep them, you can do whatever you want. And then you need to pay them back with a small fee. This fee cannot be paid in DAI, of course, because like how can you get more DAI than you minted, right? Of course, you can buy these DAIs from somebody else, but then he won't be able to repay his debt, etc. So you need to pay the debt with, and you need to pay it back with adding some fee, which is expressed in the MKR token. And what happens if your debt is too large, like larger than the value of the vault? Like that probably won't incentivize you to ever pay it back. Or worse, what happens if the value of ETH drops down and now it doesn't actually cover the synthetic debt that you issued? So it's no longer backing these synthetically created DAIs. There is a mechanism for that, of course. It's called collateralization ratio. And this is like a kind of red line. It's simplified here. It's simplified, but I think it explains the rule. It's a line that's drawn between the value of ETH and between the amount of DAI. And whenever the value of ETH drops down, so these values are met, the system says, okay, whatever, take your DAIs. We don't want to see them anymore. It's your problem now. We take out your ETH, we'll sell it on the open free market. We will buy DAI from someone else, and we will repay your debt. And basically, your vault is closed. Your debt is neutralized because we will repay DAIs from anyone else on the market. You will still manage to keep some small portion of ETH that was left for you, but generally your position is liquidated, right? Because system needs to be sure that all of the DAIs are backed by Ether. The other way around, if your debt raises so high that this ratio is met, the same will happen. The vault will be liquidated, the Ether will be taken out, will be sold, and you will just get the rest, and you can keep your DAI, and you don't need to repay the MKR debt anymore. But what happens if it happens, what happens if the situation is so rapid that within minutes or within like a 1 block period of time or whatever, like really quickly, the value of ETH drops so badly that the system is not able to react, right? It happened. It actually happened one time. I'm not sure if it was only once, but once for sure, March 2020. And in such a case, the maker system will print new MKR tokens to cover your debt. So, and that worked. So you can be sure that every DAI is always backed by Ether. This is one of its strengths. There are more, but yeah. So to summarize, make sure that your DAIs are always covered with proper amount of ETH, and the vault is safe. And actually, what's interesting, this can be done with other types of collateral as well. So you can, for example, put your Bitcoin into the vault and then borrow against that. So you don't need to actually sell it to use its value, right? You don't need anymore to necessarily sell the currency, cryptocurrency, but you can lock it, borrow some DAIs against it, and then just repay them and use them in a way that you would like to use them. And in the future, that's not true at this point. This is like future, probably. Maybe at some point you will be able actually, for example, to get a mortgage on blockchain, right? Because you need to lock a tokenized real estate into the vault, and then you would be able to issue some amount of DAI that will be able to help you complete the purchase, for example. That's future, I guess. What can it be used for? Like this whole thing, because like now I showed you like 2 simple primitives, which is like one is like pooling stuff into like putting stuff into one pool and then borrowing and then paying interest, and now issuing a synthetic asset which is backed by some other asset, because it sounds like it's very like what can it be actually used for, right? So let's take an example. You can create a leveraged token. So for example, you can put Ether into the vault, mint some DAIs, then sell the DAIs for more Ether, put this Ether into into another vault or into the same one, whatever you prefer. Then you can mint more DAIs, buy more ETH, etc. Like create this leveraged position. And then at the end of the day, when you have, like at the very beginning, you had like $200 of worth of ETH, but then when the price changes, like you get more. Of course, it's dangerous, because if the price of ETH drops, then you can then you get less. But what's powerful here is that it's not trusted, right? It's not like there is some sort of central authority that allows you to create or use this kind of product. That this is something that's naturally created on top of blockchain. This is something that's fully automatic, that makes sure that everything will be fully backed, repaid, and properly managed, and you can be sure that it all works well. You can do shorts. You can, for example, put DAIs into the compound pool, borrow ETH, sell it, and then when the price of ETH drops, rebuy it for a cheaper price, keep the rest of the DAI. Of course, the other way around, you will lose, but that's how market works. And here, there won't be like any stopping the market and like deciding that it's volatile and dangerous. You should be doing more. You can whatever you think is okay, whatever you think is not risky, not too risky for you, and there is no one to stop you, if not the smart contract logic, which is always making the final decision on what can be done and what cannot be done. And the other thing is just you can actually buy stuff with these mechanisms, right? Because, for example, believe me or not, but there are some people that consider their cryptocurrencies their wealth, and they do not actually intend to sell that ever, or not in the near future. So if you want to buy something, you can actually put your cryptocurrency into the vault, issue some DAIs, and then, for example, hope that your debt will be rising slower than the value of your ETH, which might happen, might not. You can repay it. You can actually use the value of your currencies without getting rid of them. Or at some point, you can just liquidate the vault itself with a flash loan, right? So I will explain that sometime in the future, I guess. But that's also what's on the table. Is there more? There is. There are dozens of different kind of things. So, for example, there are decentralized exchanges. It's always very controversial topic, like the decentralized points of failure, right? The stories of the cryptocurrency exchanges that were failing, and they were closing the markets, or they were just disappearing. This problem doesn't exist anymore. If you are using proper tools, there are products that allow you to exchange stuff on chain without there is, of course, a risk, the protocol risk that something will fail or the whole blockchain will disappear, but it's like significantly less risk than using a centralized exchange. So yeah, and you can also like compose stuff that utilizes these exchanges and perform some automatic operations. I won't dive deep into the decentralized exchange kind of topic, because we'll have a presentation from Alex, and he will explain everything. There is yield farming, which is like a very trendy topic these days. So I wanted to mention it and more or less explain what it's all about, because probably if you are completely new to DeFi, then you probably haven't heard about it. That's fine. But if you are not new to DeFi, then you probably heard that. So what it is? We had this simple compound example, right? There was someone with some amount of DAI tokens, which were located to the compound pool. The C DAI were issued, and this depositor was earning some yield on top of that. So this is the simplest form of yield farming, right? It's not very sophisticated, but it is one. And let's stick to the compound. So because actually compound probably was the first one to create a product that created the term of yield farming, because they started adding a comp token. So the active users of the compound protocol were allowed to claim some small amount of comp token. Comp is like a internal compound governance token, which empowers you to take decisions about the future of the protocol. And what happened? Apparently, the comp token was so valuable that it was okay for you to not only deposit your DAIs into the pool, earn some interest on your DAIs, and also earn the comp tokens. Actually, it was profitable for you to deposit DAIs and borrow ETH, then deposit this ETH again into the pool, not repay it, just deposit it again. So you have like more deposit, right? You actually like this deposit is like is losing value because you're both lending and borrowing at the same time, which like you cannot profit from that. But this small amount of COP tokens was compensating that, and it was worth it. And then you have borrowing power from the C ether that you have. So you borrow more DAI, and then you convert it to the C tokens again, and you again borrow more comp. You acquire more comp. And apparently that was pretty scary moment, because lots of people were thinking that it's gonna blow up and there's gonna be disaster, but there was nothing like that. It's not that profitable anymore. However, it's still like the using compound is profitable, but these crazy things are not that profitable anymore, and that's how it was all proceeding, let's say. And now all different protocols are also having their own token, which is used for something, and that's supposed to bring value to their holders, so people can actually do something interesting. And here we can ask a question about the comp token itself, like what is it for, right? Because like it shouldn't have any value at the first glance, right? Because Ether is the cryptocurrency. Some people are even at this point of time still asking questions whether cryptocurrencies have value at all. So that's one thing. Then we have these DAIs, and if we consider Ether to be valuable, then probably we should also honor DAIs and their value. But what is a comp token? Yeah, apparently there is this powerful governance thing, which actually makes DeFi really decentralized. So whether anyone wants to change anything in the compound protocol, people that hold comp token decide whether this is a good option or not, and they vote whether they want to this improvement to go live or not. And that's essential, because there's like no central authority. Of course, not every project is starting from this point. This is when the projects evolve and develop, they are moving towards this decentralization, and they start probably with an owner, but then at some point they gain some traction, they gain some group of dedicated users, they have a community. And then this community actually governs the protocol, and that's very important, because how do we know that these random people from across the internet will know what's good for the protocol, right? Or will have good intentions, right? Because we are actually now, like, for example, the creators of Compound actually passed the ownership of their child, of their company, to random people across the internet who can do anything. Why would they act in a way the Compound Foundation wants? Because by holding this token, they expose themselves to the success of the compound, right? So the value of the comp token will probably go up if the compound is doing well, if compound is successful, if it's aggregating a lot of fees, if it's just prospering, and will decrease in value if compound is not doing okay. That's a similar thing to the MKR token, for example. These holders of this token are really interested in the protocol doing well. So we actually have a system of really healthy incentives for random people from all across the world to cooperate and to democratically make a solid, reasonable decision. And there is here's no place for populism or pure politics. It's always it's pure meritocracy, where the facts and the best ideas are the ones that are picked, and these decentralized protocols are actually doing extraordinarily well. Right. And there are like plenty of other things. There are NFTs, which are digital art. So you can combine. You can have like a unique object, like piece of art or anything else. You can put it on a blockchain and you can put it up for sale. There are options, because I'm now leaning towards the end. Actually, at this point, if you have any questions, you can start thinking about them, because there's going to be a Q&A session at the end. So there are options. So fancy things, fancy instruments for the pro traders, pro investors. There are indexes. So for the less pro investors, if you don't want to pick any one particular token, you can buy like sort of an ETF which aggregates a lot of tokens inside, and for example, allows you to buy a whole sector, not only like a particular one random cryptocurrency that is gonna succeed or not. You can just spread the risk. There are insurance protocols that allow you to buy insurance for your smart contract investments. So for example, when the smart contracts are when there is a bug in smart contract, which happens, then you can get some sort of refund from this protocol. And actually, that's very fresh situation, because there was some sort of an attack on one of the protocols recently, and the insurance went extraordinarily well. And people that were using it actually took no loss, because they were just insured. There are plenty of other things. I think it's not a bold statement if I say that here on Ethereum blockchain, mostly, I don't want to exclude other blockchains, but I'm mostly focused on Ethereum blockchain. It's like the closest to my heart. We have sort of Internet of Money effect arising. Ethereum is not a product itself. It's even probably not a platform. It's like a transact medium that allows new creators, new inventors, new startups to build all sorts of new things on top of what's already existing. And I think it's really exciting, and I think it's really worth learning, and it's really worth building. And yeah, I hope that you got interested. And I hope that you're gonna decide to learn more, because here what we saw was just like a tip of the iceberg. It's just like the first sip from the very tall glass of DeFi. And I recommend you to dive deeper. Okay, thank you for your attention. And if you have any questions, then I'll be really happy to answer them.
Hello back. Great to see you. Let's wait and see if we have any questions. Let's give it a couple moments. Here comes the first one.
Okay, I see the first one.
Yeah, Bartek, I'm gonna read the questions and you're gonna answer. How does that sound?
Okay. So does Maker have a plan to create tokens pegged to other fiat currencies or other assets, example gold? I'm not aware of such plans. Probably, of course, the people from Maker Foundation would be the best to answer. But what I know is that there are plenty of other products that issue other fiat currencies. We have at least two types, two separate synthetic euros. On Ethereum blockchain, there is the Trust token company which issues through Hong Kong dollar, Australian dollar, Canadian dollar, there are probably more to be found on the synthetics. When it comes to Maker, I'm not aware, but there are plenty of other projects that do that, and gold is also available, at least in 2 different flavors, because I've seen it. So if it's Maker, I'm not sure, but definitely this is something that's present.
Yeah, I think definitely more than 2 gold stable coins. Yeah, plenty. I heard the rumors that Maker is indeed planning more currencies in the future, but that is not official information by any standards, by any means. I think we have at least one more question. Let's see if it's coming. If it's not showing here, I'm gonna read it aloud. Can I? It was asked by David Sech on Facebook. Can I use compound governance protocol to govern my DAO?
So it depends what's the question exactly about, because I can see at least 2 ways to answer that. So, for example, what you can do, you probably can fork the compound governance smart contracts and implement systems similar to theirs. Because it's open source. It of course has some sort of license, but it's public to some limitation, and you can implement mechanisms that will work similarly. That's one approach. The other, if you're for example creating some compound related product, you can create smart contracts in a way that holders of the comp token will not only be able to govern the compound protocol, but also your protocol. Yeah, I think I don't know how to approach this in a different way. Maybe I'm gonna read it again just to make sure. Yeah, generally, if we are talking purely about the protocol itself, which is like basic primitives and basic mechanics and the smart contract design and architecture, etc., I think that you can utilize these patterns in your project as well, and it might work. Of course, you need to probably first have a community and find a way to distribute these tokens, etc. This is the hardest part. I think that creating the protocol is probably the easiest at the end of the day.
We have one more question coming. Again, I think there's gonna be. I think we have more questions coming. So let's take this one first.
Okay. Yeah, so do you think we'll see financial NFTs in the near future, and what it will do? Yeah, I was actually brainstorming this topic some time ago. I think that we will see more NFTs use cases coming. So right now, they're almost exclusively collectibles and digital art, which is like probably for a very narrow audience, and not everyone wants to get involved into that. But I think that there are plenty of usages and use cases for NFTs which are not related to any sort of art. For example, at this point, some transactions on synthetics that are not atomic and that do not complete within one transaction mint you an NFT, and this NFT then allows you to claim the result of that transaction. So that's one thing. The other is, I think that we will probably see some sort of ownership proxy created with NFTs in the future, right? Because right now there is like one owner of a Maker Vault, for example, and I think that in the future we will see an ownership of a Maker Vault as an NFT, and then you can, for example, pass this ownership of Maker Vault to anyone else, or you can pass it to the protocol, and you can actually build on top of that. Also, there is Alpha Homora, which allows you to create leveraged yield farming positions, and they are all unique because you cannot participate in Alpha Homora like in very like kind of like crowd sale type of thing. So it's not like one pool. Every position is unique, and everyone needs to like create and maintain own position similarly to the maker vaults. So I think that this position also shouldn't be owned by addresses. Probably they should be some sort of NFTs. And I think that a lot more are coming, and like anything that is non-fungible in a very high level way will be tokenized at some point. I don't know if that answers the question. I hope yes. If you want me to leak some real alpha then I'm afraid I don't have like killer app ideas for NFTs at this point, but I think they will be seen in a lot of projects, and they will be very useful
in the future. I think we have a few more questions. Let's take one more and push all the other questions to the networking at the very end. So let's see if we can see the next question.
Maybe it's gonna be short, so we can take two. But no, just kidding.
Waiting to start his presentation, so let's generate a delay. I think the other question was on Discord. And thank you for introduction to DeFi. Could you tell us a little bit more about real use cases? We are a company that is purchasing insurance claim with a fiat currency, and we would like to explore where DeFi could be potential for financing this instrument. So real use cases, real insurance claim that is bought with fiat currency, and what are the possibilities in terms of DeFi being a way of financing real life insurance claims?
Okay, so that's a tough one. That of course I think depends on the level of decentralization that you want to have in your product at the first place. Because probably if there's gonna be like one central authority that's gonna, for example, decide whether the claim is rightful or not, then it's gonna be like then I'm not sure if it's gonna be like a perfect fit for a decentralized solution. But generally, I think that the whole like insurance industry, like as a whole, might move to DeFi at some point. Actually, this is like really complicated question. Yeah, I think it might be worth to take it offline to the networking session, because there are like plenty of different things. Maybe I'm gonna finish with a statement that I think it makes sense to move insurance products to DeFi, even if they are bought with fiat money, like at the retail consumer end. But it heavily depends on the exact use case.
I think to summarize, I think there are definitely opportunities, but that haven't been tried much so far. And that is connecting blockchain, virtual space into physical. So that is not that much explored. Although we see first loans that are kind of there. So there's, for example, the startup called TrueFi that we would know a little bit about, and especially Bartek, and who was involved in creating this. And the idea is that you have a DAO, and there is a voting, and the person who is borrowing needs to be approved by the DAO. So it's like one of the first working. I think they actually have tens of millions of dollars already there in the pool. So it's the first working with reasonable capital kind of use case. But that is a new use case. This is a new thing. This is like 2 months old. So this is going to be happening this year. So then the question is, are you want to be a frontier? Because if you do, that's perfect. if you want to look at other people actually doing it before doing it yourself, then it might be not perfect timing for you yet. I propose, I think we should be ready to introduce the new speaker. I know there are new questions coming, so please bear with us till the end of the second presentation. We're going to have a networking session, and hopefully Bartek will be with us. I'll be there, and I think plenty of other people who know a lot about the space will be there. Perhaps Alex will join us as well. So now let me tell you just a few words about Alex before we connect him. So Alex is a very well-known persona in the DeFi and in the blockchain and Ethereum space. Alex was, I believe he was like fifth, maybe sixth, one of the first employees of Ethereum Foundation, just very early after the ICO happened and the whole thing started to be shaping. Alex was involved in many very basic projects in Ethereum space. He created block keys, so the small icons that you can see either in MetaMask or in many other applications. That was idea that came from Alex, and he created that. And he worked on many interesting projects, first wallets. Together with Alex, we were working on Unilogin. And today, Alex is working. And I want to mention before the final thing, Alex was involved in White Hat hack when there was a hack in the wallet that led into leaking a lot of money. Alex was there in the room when they hacked those wallets, take the money, and return the money to the holder so that the black hats and the thieves could not utilize the hack. To do that, that was a huge event a few years ago. Now, today, Alex is working for Balancer, and Balancer is one of the top DeFi projects we have today in the space. They are second to Uniswap, and that's pretty much it. And they have very innovative idea. Like if DeFi space is not innovative idea, if Uniswap is not innovative decentralized exchange, then Balancer is even more innovative. And all about that, Alex will tell you just in a moment. So without further ado, I think we can have Alex joining us now. And here comes Alex. Alex, great to see you.
Thanks for this lovely introduction.
Thank you. Just want to say before you start, it's a great pleasure to have you today. We have a lot of viewers, so it's always a little bit weird in remote when you talk to the screen. But just by amount of questions that we have for the first presentation, I think there's plenty of people listening. So without further ado, Alex van der Sande.
So I will share my screen. Let's see here. Okay, can you see it? Marek, is everything okay? Can I proceed?
Yeah, well, everything's fine. I'm leaving you alone.
Okay,
but
so
if I will rejoin if something happens, but I think it's gonna be all fine.
Perfect. So this is actually my first presentation about Balancer. I joined the project in December last year, so I'm still learning a lot. And during the process of me learning, I always like to try to I make them into presentations. So this presentation is a lot the process of how I learn what Balancer is and the point of view of what exactly that is and what attracted me to the project, right? So first of all, this is sugarcane. I'm in Brazil. We have a lot of sugarcane here. And you probably know that if you take sugarcane and you add it to a mill, you get sugar. But the other thing you also get is bagasse. And bagasse is a byproduct of sugarcane. But turns out, and that usually was just discarded, but turns out that bagasse is actually very rich in energy. And you can make it a biodiesel out of it that can be more valuable in some places than sugar. So you can say that cane, if you mill the cane, you get sugar and bagasse. But you can also say that in fact, you get bagasse and a byproduct of it is sugar. In the same way, if you get arbitrage on a curve, you get exchange and liquidity pools. That's sort of like EMM's work, how that's sort of Uniswap work. But you can imagine that as the opposite. You can maybe, what if I told you liquidity pools the project is the main product and the exchange is just a byproduct? So what happens? So first, let's talk about how automatic market maker works, right? So most automated market makers, Uniswap is the most famous one, is the most used one. They use a constant product function. And that just means there's a curve that there's a constant that is always, if you multiply x by y, there will always be in a constant. So the curve looks something like this. And why does a curve like this magically make the project work, right? So first, let's explore the characteristics of what this curve means. So basically, it means that one is sorry about the type. I just had the presentation set up and had to change the computer last minute, so all my fonts are messed up. But you can imagine that one of those the x-axis is the amount of tokens A in a pool, and the other will be the amount of tokens B in a pool. An interesting thing is that a Uniswap, like a Uniswap or any EMM, they actually don't know anything about the prices. All the information they have to work is the amount of tokens they have in a pool. And whenever you move and you add more tokens in the pool in one side, the ball simply moves on that direction, right? And you can imagine the way you can think of it, of course, the exact formula is you actually get the delta of those two, but you can imagine as if you're getting the amount, it's sort of similar to getting the amount of tokens similar to that, right? So if you as you move the pool on that direction, now you're getting more green tokens than the blue tokens, and if you move it in the other direction, now you get more blue tokens than the green tokens, and until it reaches some equilibrium. But why exactly does it work that equilibrium will always be the same prices, and you not only you reach an equilibrium where we have the same prices, but you reach an equilibrium where the liquidity pool always will have the same amount of value in the pool, which is interesting because Uniswap doesn't know what is the price of the pool. It just happens that every liquidity pool will have an equal amount of Ether, an equal amount of DAI, or whatever tokens that is, right? So if we need to think about, the interesting thing is that actually there's nothing to do with the product function curve. It would work the same way if it was a curve like this, or a curve like this, or even whatever, a curve like this. It doesn't actually matter which type of curve you use. It's just that we are using this constant product because it's a practical curve, and there are some interesting characteristics about it. But what I want you to think about is the value of tokens in the pool, right? How do we think about what is the value of tokens in the pool? And of course, value is the amount times the price. So you can think of the price as a multiplicator. So if this token A is worth $2, you can imagine it as a multiplicator, and then we can simply fold that line. And if the amount of tokens B is 50, like the other tokens were 50 cents, think of it as halving. And then all you need to do is get the half, fold it in, right? So this is really the amount. Now you can see that the values, while you had like equal amounts of tokens, the values are completely wrong. Which means that basically if you give them tokens B, you get tokens A, and it's free money. Like if you get $1 of token B in the pool, you get $4 out of token A, which of course you should. Then people are going to go here, and the more because. So imagine that as a sort of like two vectors. When they are out of equilibrium, people will push them in one direction. And the more you push and the more you put token B and token A, the more they will reach some sort of equilibrium. And always I'm doubling one side and halving the other side. Imagine it's all happening like faster than the price is changing, right? Until you reach an equilibrium. And from that point on, you can see now that the green line is bigger than the blue line, so it's going to push it down again to that other point. So I want you to think of EMNs not really as mathematics, but really as physics. It's basically, imagine there's a ball and those 2 points, that's the gravity, and it's going to find the little point where the gravity sort of reaches an equilibrium, and it's going to stick there. And because it has those, and because it will stop that, it will stop at a point where value times amount is equal, that's why you get a liquidity pool, in which meaning that if you add liquidity to if you add liquidity to Uniswap, and you add Ether and you add DAI, if you add $100 of Ether and $100 of DAI, you always have an equal amount of Ether and equal amount of DAI. And why is this important? It's important because it means that Uniswap is used for trading. It was built for trading. And as a byproduct, you get a self-balancing portfolio of 2 tokens. And Balancer actually was created almost at the same time as Uniswap. And in order to create a self-balancing portfolio, and they ended up in finding independently in the same solution of Uniswap, but from the other direction. Meaning Balancer creates self-balancing portfolios for any number of tokens, and as a byproduct, you get trading. So the idea here is that you can create any sort of self-balancing portfolio for a number of tokens, and the traders, the arbitrage people, they will be the ones that will be managing, and they will be automatically changing the amounts in your portfolio. And why that is important, right? Let's think about sizes of product. Right now, Balancer is at number 10 in DeFi pulse. We just crossed the 1 billion mark. Maker has 6 billion, Av 5, Compound 4, Curve 3, and Swap 3, right? If you think about them visually, it's going to look something like this. If $1 million is just the size of the dot in the eye, then $1 billion is this ball, which is big. And that would be the amount of Uniswap, $3 billion and $5 billion. Which means, look, Balancer is big, but who is really bigger, right? If you compare it for Robinhood, which I suppose it's going to go down a little bit now, but that last time I checked, they had $20 billion in assets, which, it's a lot bigger. But even bigger than that would be Berkshire Hathaway. That's mainly that's just a fund, right? And what they do in the fund is that they have a self-balanced portfolio. They keep 20%, 10% in cash, 20% in option, in this stock options, 30% in this and that, right? And usually what they do is they just set up a strategy in the beginning of the year, and they just really follow it, right? So maybe if you could automate it, and even Berkshire Hathaway is small fish if you think about it. So this is Vanguard, which is not showing, but I think it's $5 trillion. So again, this is us. This is home. The pale blue dot, right? This tiny thing there, which represents Balancer, is $1 billion. All those tiny moons there, the little circles, this whole thing that our friends have been talking about DeFi, we are just a tiny moon compared to the big stars that is both of those index funds and those automated ETFs. And my point being, we can probably automate that. If you want Ethereum to be the future of finance, then we probably can think of how can we automate Berkshire Hathaway? Can we just replace every asset manager at Vanguard with just a bot where you set a strategy and you let the bots do everything? And I think that's an interesting proposition. So we can think of pools, balancer pools, are mostly just three things. There's a bunch of assets. There's a strategy, which is a trade curve. You can set really any sort of trade curve that you want. And there's a governance, which of course can be done. You can simply set it, I'm going to create this pool in the beginning, and it's going to be like the same thing forever, right? That's like no governance is a type of governance. And with just those three things, you can build a lot of different things. My point really is that I see pools as almost a new primitive, new economic primitive that you can build a lot of cool things. And in fact, if you're building things with them, it saves you a lot of time and trouble. So, for instance, like you can start with basic pools. Basic pools are what we have right now in Balancer, which is just you create at the moment up to 8 tokens, and you set, I want to have 64 of this, 40% of that. I want to have 8 tokens with this distribution. And then and then you set up a trading fee and a few other things, and you have like, and you can put $1 million in, or $1 billion, or $1, whatever, and the pool will always self-balance. And it self-balances because whenever there is a difference of like the size of the pool, by people trading in the Balancer exchange, which is connected with other exchanges, and there are people running arbitrage bots on it, like they will make sure that your pool will always like go back to where it was. An interesting thing is that instead of paying an asset manager to make sure your money is with the right proportions, what actually is happening is that you're being paid to do it. Because whenever someone trades, they pay liquidity fees, and that liquidity fees will go back to the liquidity owners. So it's a great way. Imagine it. Instead of you paying Berkshire Hathaway, you can be paid by just putting your money there, which like sort of how it should work. But you can build all of other things. So for instance, PyDAO is building autonomous index funds and Balancer. They are using a smart pool in their backend, and basically what they do is they help create you a DAO, and it's great because Balancer is super flexible. You can just plug any sort of ownership on that, and every pool has their own pool tokens. So you can use that pool automatically to use as voting mechanism, right? So you can imagine a discussion of reinvesting or investing or cash flow or anything as just you trading percentage. You can say, look, we have right now $1 million, half of it's in Ethereum, half of it is in DAI. And you can say, look, I want to invest $100,000 in this new project. That in the size of Balancer, which is simply mean we're going to take a little slice of 1% of the DAI amount, and we're going to convert that in 1% of this redeemable token, or this other token that represents somehow your project, right? And the nice thing of this is that let's talk about like Moloch DAO. I'm not sure if you have heard of, but Moloch DAO is a very popular like minimum governance DAO, in which the idea is that people discuss, people vote where the money goes, where the money doesn't go, and if you disagree with whatever, like with the discussion, at any point you can simply quit the DAO and get the tokens out of it, and you're good for it. An interesting thing by putting that on a smart pool, you get a lot of that automatically. Because the minute you hold a Balancer pool token of any pool, it means that you can always trade that you can always burn your tokens and burn your liquidity tokens and then get the tokens themselves, right? Another project, Catnip. Catnip became very popular at the end of last year because they try to bring prediction market. They are building prediction markets on Balancer right now. And they do a prediction market as simple as Uniswap. If you go to their website, it was like, oh, who's going to win this election? You either buy a Biden token or you buy a Trump token, and that was it, right? It was a prediction market stripped down to its bare minimums, and they are building it on Balancer. Prime DAO is building liquidity bootstrapping pools in Balancer. So that's another very interesting thing that's happening. I know there are a lot of people using LBPs, and I want to explain what they are, because I like to think of liquidity bootstrapping as almost the new. It's almost like the new ICO, right? You want to raise money or you want to launch a token, and how do you do it? You probably heard about average dollar cost averaging. Dollar cost averaging means you have $100. Let's say you have $100 and you want to buy $100 in Bitcoin, right? Or you have $1,000, you want to buy $1,000 in Bitcoin. You could just go there and buy $1,000 in Bitcoin. And what will happen is that if the price goes up, yeah, lucky you got in a nice moment. But if the price goes down, and then you could have bought a lot of Bitcoin for cheaper, right? So instead of just buying $1,000 in Bitcoin, suppose that you buy $100 or $10 every day or $1 every day until you get, every month, every week, you buy a little bit of Bitcoin. And what's going to happen is in the end of when you get to $1,000, you're going to be exposed basically to the average moving price of Bitcoin. When Bitcoin was going down, you bought more of it. When Bitcoin was going up, you bought less of it. But in the end of the day, in the end of the period, you have bought $1,000 in Bitcoin, probably at a much better price than if you had randomly picked any moment. So liquidity bootstrapping tool does that, but with a pool that you set to automatically change the amounts. So it starts as, let's say, 99% F and 1% a new token, right? It can be ETH, it can be DAI. Let's say you start at 90% of ETH or a very popular token, and it starts as a 1% of one token. Suppose that one token doesn't have really a lot of liquidity in it, so you don't even know what is the correct price that this token should have. The cool thing is that if you put, let's say, if you start pool with $1 million of DAI or Ether on it, or of course, this $1 million can be by multiple people. I'm not saying you need a billionaire to do that. The point is that the pool will start with a tiny percentage of that, of the token, which the market will sort of try to figure out what is the correct price of that token. And then the next day it will be 2%, and the next day it will be 3%, the next day will be 4%. And what's going to happen is, while the market is still trying to figure out what amount of tokens, what is the value of that token, you're starting to give it more and more and more liquidity, until by the end of it, you basically sold all your Ether, you bought that token at the price that you helped discover. So the advantage of that is that, first of all, you don't know the market price of a token, and that can work with any market price of a token, right? Because it's always at, let's say, at some point, at this week, it's going to be a 5% this token. It's going to sell or buy more of that token. If suddenly the token price goes up or down, your pool will buy and sell Ether, buy Ether, sell the token, buy the token and sell Ether, to always have 5%, right? So the pool is sort of absorbing the changes in the token, and by the end of it, you get great liquidity for a token. So advantages. Number one, for people buying this token, they allow you to buy a token that you don't know the price without being too much exposed to price variance. You're going to be basically buying that token over a week or 2 weeks or a month, depending on the liquidity bootstrapping event. For the token launchers, it's great because they are helping the market figure out, and by the end of the event, they will have a huge liquidity for that token, and now it's hard to move the market around. So the goal here is to say, that's all happening in Balancer right now. But right now we are really working on V2. And what V2 does is interesting. First of all, we are really focusing on making it gas efficiency. The way that every automatic market maker works right now is that every pool holds their own tokens and you plug in the curve and it's one contract, right? If you wanna, and what we are doing is that instead of adding all that logic in the same contract, we are working with a very secure and super audited contract that it's going to hold all the tokens, and you connect EMMs into it, right? And I think it's fantastic because suddenly you can create any sort of EMM you want and just plug it in and say, this is how much tokens, like this is how you trade tokens, and then you can add tokens through it. Another super advantage of that is that when you do multiple token trades, when you do arbitrage, it's actually a lot more gas efficient. Because first of all, so let's say you have like 3 or 4 pools, and you figure out like if you exchange token A in that pool with token B in that pool and token C in that other pool, you get 1 DAI arbitrage per arbitrage. If you want to do that in AMM right now, you need to have all those tokens, and you need to execute all those buy and sell. You need to buy and sell those tokens constantly in all those pools. So you spend a lot of tokens. If you doing that in Balancer V2 just means that you're going to send the information of all the trades that you want to do, and it's going to just execute on chain the net result, right? In the end of the transaction, all the tokens that will move is the tokens are the net result. So what could happen is, in fact, you could get an arbitration profit without even having any tokens. How cool is that? You will never put any tokens in. You just realize that if you trade with A, with B, with C, with D, you get per profit out of it. So it's good for gas efficiency, and it's also good because it increases liquidity in our pools overall. Another cool thing. Oh, I just figured out I just explained both things at the same time, right? So yeah, so this is the idea that before we had 2 sort of pools, and then it allows you to have really any highly customizable logic. And you like any customizable logic in fact, because if you made the project curve.finance is really launched interesting. One of the things that they do is that they have a very different curve for stable tokens that you have for normal variable tokens. So if you have a pool of USDC and DAI and Tether, you can have a very different type of curve than you would have with, let's say, Ether and Bitcoin and Baker. And the final thing, I think that sort of like blows my mind, is capital efficiency. When you put 1,000 tokens in the DAO, in the vault, right? You probably only a tiny percent of those is going to be used in trading. Like most of them are going to just be sitting there on the vault. And with the new token, with the new V2, we have this concept of an asset manager, where you can set a contract to automatically pull those tokens, add them to a lending protocol, which is, let's say, like Compound or something like that, and then bring them back as you need it. So it's almost as you have like but you have $1,000 there, and you realize that you only trade in average $100 per day, or maybe $50 per day. You only need to have like $100 in that actually queue, like live in the pool, and as those tokens get traded out, then you bring them out from Compound or any lending platform, which is fantastic, because now you can keep your pool. You don't need to choose, oh, I have like one DAI, should I put it in Compound or Curve or Balancer or this or that? You can actually put them in multiple places at the same time. And before you say, oh, is this like, that doesn't mean that you don't have the collateral, right? No trade will actually be taking place unless that collateral is actually there and exists, right? And if I try to make a big trade with a given pool and it doesn't have that, like we are not even send that trade to that guy, because like that transaction will fail. So my bigger point is Balancer is really for builders. We want to build a project, and we are building an app, and we are excited about building an app. But really what we want is to build something that other people can build on top of. Right? It's almost like in this universe of money Legos, we are launching this new little customizable piece that can connect a lot of other things, and it's a very powerful piece, and you can build a lot of new things in this money Lego. And you can learn a lot more about Balancer by going to Balancer Finance or Balancer or Twitter at Balancer Labs. And we're hiring, so like if you're excited about this, if you're excited about working on the future of money Legos and being a part of this DeFi revolution, like we are like, just shoot an email, right? Like right now we are looking for all sorts of positions. So like on UI, on front end, on back end. So if you have like any sort of interest in that space, just shoot us an email and we'll be happy to talk. And that is the talk. Thank you.
Hey, and we're back. Thank you for a great presentation, Alex. That was pretty fast. I think there might be some questions. I think that we have at least one question here. I'm going to read it in a moment, but I will wait for the question to show up if Mateusz is able to. It's kind of a long question.
It was 30 minutes, wasn't it?
It was 30 minutes, so the time was good. Okay, I'll start reading the question. Oh, okay. Here comes the question.
Yes. Will Balancer be available on second layer? We are working on that. We are looking at that. So the one interesting thing on that change that I mentioned on Balancer, that a very cool thing is that we are making our car contract, a very, very basic car contract that you can plug in a lot of other things, right? So as soon as there's as soon as we want to move to it, like anyone can actually create a pool that is just pointing out to a second layer. And we are also looking at roll-ups and ZK things and all of those technologies that will create this own pool that will connect you to the second layer. So yes, we are looking at layer 2. We haven't seen any solution that we truly believe in, and we are sort of like skeptical of solutions that run their own chain. We are very excited about those that are basically rolling up into Ethereum chain. So we are waiting for that.
Yeah. I will just add a couple of words of explanation because not everyone might know what L2 is yet. L2 are scalability solutions for blockchain that are just emerging right now. There was really nothing working just half a year ago, and now there is at least a few. And in a month, we're gonna have a meeting exactly about layer 2 solutions. So it's gonna be everything gonna be explained. And I think it's time for the next question. Let's see if our studio. Okay, very nice. Buy BR, good exposition. Yeah,
that's a Vibe Brazil hashtag. I'm not sure what he's talking about.
Let's read the question first then. Why is Beeple designed to be unusable after any liquidity is no more than there and I can't even be added back?
So I hope that's a bug that you found somewhere that you're not. So like if you're finding, if you're having any trouble adding liquidity to a pool, or like feel free to share, to jump into our Discord. We have a Discord, we have a Slack, and I would love to hear more about, like, maybe we can try to figure out what the problem is that you're having. I'm not sure what you're talking about, sorry.
Mm-hmm. Yeah, we're going to have networking. Alex, will you have a little bit more time to stay with us on networking session?
Yeah, sure. I can
Awesome.
do that.
So let's take it there. Let's see if we have more questions. I think we still have time for 2 or more questions. Okay, I can read one. I'm not sure, it's not showing up here. In a classical governed portfolio, you have exposure to different assets and rebalance, let's say, every half a year. Some assets perform better, some worse. Won't too short feedback loop and too frequent getting rid of well-performing assets cause too much impermanent loss? Yeah. So the question is, if we're gonna rebalance too often, yeah, then impermanent loss. Do we have? Did we explain what impermanent loss is?
Well, I didn't explain what impermanent loss is. The reason is that I haven't still found like a great solution, a great way to explain it. But the short version of it, because of the way that EMMs work, slowly as asset prices diverge, and that doesn't really, some people call it divergence loss, which I think is interesting, meaning that when prices sort of diverge, you like the amount of money the amount of value that you get by holding a token of that pool is a little bit less than just say holding that pool, right? So let's say you have a pool which is 50% Ether, 50% DAI, right? And then you bought it when Ether was like $500. Now Ether is $1,000, right? If you had like the amount of money, the value of that pool will not be the same as if you had just kept like just had one like half Ether or half. Like if you had just held one Ether and one DAI back then, right? It's always going to diverge, and usually the way that but that is usually compensated by trading fees, right? So the more people are trading, the more basically they get that back. So and impermanent loss or divergence loss will like sort of like disappear as if the tokens come back to the original price that you bought. So impermanent loss depends on when you bought an asset or what the market conditions were. They are always be there, and it's usually like there's a trade-off. It's like if the pool has enough liquidity and enough trading, you will you get that back. So an interesting thing is that it doesn't depend on how often you trade. Like we don't rebalance pools. Like pools are rebalanced every time someone buys one token or buys the other token. In our exchange, they are rebalancing almost like every pool that they touch, right? And impermanent loss, it doesn't depend on how often you rebalance. It just depends on what price you bought a token and what price the tokens are right now.
Well, so impermanent. Okay. There is one more. I just want to add about impermanent loss that it is tricky to understand. It is a little bit tricky to understand, but the important part is that if the value of the assets change, so let's say Ether is getting more expensive versus dollar, then there is some loss to those who provided liquidity. But if they came back to the same price, the loss is effectively you get the money back. So this is a little bit unintuitive at the beginning. I propose we do one more question, the one that we see here, and then and then we can go to networking. So question about scalability and expansion plans. What are the main challenges and constraints you see to overcome large fins, DeFis or fintechs? Large fins, and to start talking about small mid-wealth management companies.
I think so. So if I understand, it's basically how do we get out of this DeFi and Ethereum bubble, and how do we start tackling on getting actual like finance people, right? I think there is a lot of that is about scalability. Right now, it's just very expensive to do it. There's a lot of it that is about UI, and we're like that's the part where I'm more excited about. That's the part where I'm working directly on it. So one of the things that attracted me into Balancer is that I really dislike their current website and toolings, right? I think they're great project, but their current site is a little bit confusing because if you actually go to Balancer site, you don't actually discover any of those things that I've been talking about it, because it sort of looks just like a Uniswap clone. But like you get into it, you have to click on add liquidity, and then you figure out, oh, there's all those cool things happening here. And then that's sort of where you get into that, right? And I think that's what we're working like. So we are working on just improving the UX so that it's fun, as beautiful as, let's say, using Robinhood, right? And I hope that we get there.
Wonderful. So let's then point ourselves to networking. So here's a link. You can see it on the screen: http://0xNetwork. So we're meeting on Remoka platform. I think it's called Remoka. It says Remoka, yeah, remo.co. And the platform, you need to go there, you need to connect there. And when you do that, you will need to click on a specific table. And on the table, you're gonna need to enable your camera and enable your microphone. And then we can talk. I think Bartek is already there, and myself and Alex is joining any second now. So yeah, I will stay here for one more minute to make sure you can see the link, and we're also gonna post the link on Facebook and on Twitter and maybe on YouTube as well. Let's see if we can actually do that. So I think Alex is already gone for networking, and I'll be with you there as well in just a second. Link. Here it is, and let me see if it's on YouTube as well. I'm just making sure the link is everywhere, and then I'm gonna leave you, and we're gonna meet again on Remoka. Yeah, the link is there on I think the link is there. So yeah, thank you very much for being with us today, and see you on networking event.